Hello there. We're often told that we should make our money work for us, rather than simply working for our money. But for many, the stock market sounds like a high-stakes casino reserved for people in expensive suits. In reality, it is one of the most effective tools for building long-term wealth. Today, we're stripping away the jargon to explain what stocks are, how they work, and the essential risks you must consider before parting with your hard-earned cash. So, what is a stock? Quite simply, it's a piece of a company. When you buy a share, you are purchasing a tiny sliver of ownership in that business. If you own shares in Apple, you own a piece of every iPhone sold. If you own shares in Shell, you own a bit of their global energy infrastructure. Companies sell these shares to raise money to grow, and in return, you get to participate in their success. If the company grows and becomes more profitable, your piece of the pie becomes more valuable. There are two primary ways to profit from stocks. The first is capital appreciation. This is the classic buy low, sell high. You buy a share for £10 and 5 years later, you sell it for 20. The second is through dividends. Think of these as a thank you payment. Some established companies share a portion of their profits directly with their shareholders on a regular basis. It's a bit like earning interest, but you still own the underlying asset. It's a favorite for those looking to build a passive income stream. Let's look at the balance sheet. On the plus side, historical returns. Over the long term, the stock market has consistently outperformed savings accounts. Liquidity. Unlike property, you can usually sell your shares and have the cash in your account within days. Diversification. Through index funds, you can own a tiny bit of hundreds of companies at once, spreading your risk. However, we must mind the downsides. No guarantees. Unlike a bank deposit, the value of your investment can go down as well as up. Time commitment. To do it well, you need patience. This is a marathon, not a sprint. Market sentiment. Sometimes prices drop not because a company is doing badly, but because the world is in a bit of a panic. Now let's talk about risk. The biggest risk isn't the market, it's often our own emotions. Panic selling during a temporary dip is how most people lose money. There is also inflation risk. If your money is just sitting in a cupboard, it loses purchasing power. Stocks help combat this, but they bring volatility risk. You might see your portfolio drop by 10% in a week. If you need that money for a deposit on a house next month, that is a massive problem. This is why investing is generally recommended for a 5 to 10 year horizon, at the very least. Investing in stocks isn't about getting rich overnight. It's about discipline, time, and understanding what you own. You don't need thousands of pounds to start. In this digital age, you can begin with the price of a few lattes. Do your homework, keep your costs low, and remember, time in the market is usually better than timing the market. If you found this guide useful, do hit the like button and subscribe for more financial clarity. Until next time, happy investing. Cheers.